Coming up on today's show, stocks fall across the board as retail sales come in higher than expected, leading to a big repricing and Fed rate cuts. Inflation in the UK increases, a rotation into defensive stocks, Chinese stocks capitulate, along with clean energy, and Tesla cuts prices in Europe. Hey, what's up guys? How you all doing? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. I'm going to get you all up to date on everything important that's happening across financial markets. So if you're an active trader or investor, stick with me right through to the end and you'll have a bird's eye view of everything that's going on out there. And it was a bit of a bearish hump day on Wall Street, pretty much lower across the board. Even mega cap tech couldn't hold up. Saw another fall on Tesla on more price cuts in Europe. Saw a bit of a jump in bond yields today, which affected the yield-sensitive sectors of REITs and utilities. However, we are seeing a bit of a defensive rotation into healthcare and consumer staple stocks, all of which I'll show you on the charts a bit later on. Just a quick look where the major indices finished the day. Still got the S&P 500 peeling away from those all-time highs just above 4,800. Still holding the 50-day VWAP here, but that's thanks to the Magnificent 7. Have a looking underneath the hood. We are a bit weak here. Got the Russell 2000. Falling again today. Lower lows, lower highs. Just looking at my sector trends table indicator. Pretty much got every sector underneath a 5-day moving average except semiconductors. Definitely the standout sector thanks to AMD and NVDA. And it looks like we've got volatility waking up a bit here today. The VIX getting above 15. First time in a couple of months. Volatility risk premium climbing as well. Option dealers now asking more than 5 full points in implied volatility above realized. Got a bit of a jump in the 2-year bond yield now at 4.36. Same with the 10-year. Up to 4.10. Another move higher in the dollar. And stick with me, we'll come back to the charts later on and I'll show you what else I've found out there. First, just taking a look at the news that got markets moving today. That was retail sales. For December, that came in a bit higher than expected, up 0.6% from the prior month, and up a healthy 5.6% from a year ago, well above the 4% level that economists were expecting. So once again, it's the US consumer holding the economy up, and that shouldn't be of any real surprise with unemployment near record lows. Most people still have job and some discretionary spend, especially with the price they're paying at the pump, still pretty low as well. And so with unemployment really low, consumers still out there spending, risk assets near highs, nothing really breaking out there, along with core inflation still double the Fed's target. Why exactly does the Fed need a cut in 2 months' time, like markets had been expecting? If they were to cut, they may just add more fuel to a potential resurgence in inflation, and that's something they definitely don't want to do, or even flirt with. And we've even got the Atlanta Fed's GDP model showing the economy is likely to have grown at a 2.4% inflation-adjusted rate in the fourth quarter. So this whole big rally we've had in the stock market since late October has been on the notion that the Fed is going to cut rates in March, whilst the economy is still growing and everything is going to be Goldilocks. However, the bulls have reason to be a little nervous because we may not get that cut in March that has been widely anticipated. And that's why we've seen a bit of a material repricing in Fed fund futures again today. On the back of yesterday, it was only last week, market was pricing more than a 75% chance the Fed was going to cut in March. However, moving back to closer to 50-50. However, it's still confident that we are going to get a number of cuts this year. However, let's not forget, as time goes on, the world becomes more and more synchronized. And we just saw across the pond in the United Kingdom, inflation data come in a bit hotter than expected. That's the UK CPI. Index rising 4% over the last year, a bit up from November's 3.9% and a bit above what economists were expecting as well at 3.8%. We've even got the European Central Bank pushing back on the market's expectations of rate cuts, saying they might not come until mid-year, with a top bank official saying, I believe the market is getting ahead of itself. So it's no surprise we got a bump up in bond yields across the curve, especially up the front, with the 2-year increasing 14 basis points, and even got a bump up in the UK 10-year yield, now sitting at 3.98. Eurozone's back into a short-term uptrend as well, and the market could be going through a bit of a change of narrative in terms of what it thinks about inflation and pending rate cuts. And so since the market bottomed in late October, stocks have ripped up, led by cyclicals, growth. However, the last couple of days, and today especially, we're seeing a bit of a defensive rotation into healthcare and staple stocks. That's already been underway for over a week now. We can see that in the spread of consumer discretionary versus staple stocks, turning down underneath a 50-day VWAP in a short-term downtrend. And just looking at all the stock sectors today, the 3 best performing sectors was aerospace and defense, consumer staples pretty much flat, and healthcare only down slightly. Only growth sector really holding up the best is semiconductors, thanks to what's going on with NVDA and AMD, not to mention Intel holding up pretty good as well. So the question is this the start of a bigger correction? Is the market going to fully price out Fed rate cuts in March, which could cause the stock market to have a healthy 5-10% correction? Or just looking at a 1-year chart of retail sales. Year-over-year growth came in at 5.6%. That was up from the consensus of 4%. You can see it looks like it bottomed in the middle of last year, and we've moved up off that bottom materially here. So the consumer's obviously still healthy and holding up. Unemployment's low. We will get 2 more reads on the labour market with non-farm payrolls first Friday of every month next month and in March before the Fed meets on the 20th of March. We'll also get 2 CPI readings, with the next coming in on Wednesday the 14th of February. We'll also be keeping an eye on crude oil futures, a big variable in inflation, to see if that pops up by then, and of course the 2-year government bond yield to see if that can get into a sustained short-term uptrend after it's been downtrending since late October. And so right now, kind of all hangs in the balance, and the S&P 500 may just do that until we get that CPI data come mid-February. And if that was a bit hotter than expected, then it's reasonable to assume the market could have a decent 50% pullback from this move off the October lows, and that would take us down to about 44.50 on the S&P 500, and that'd be about a 7% pullback from the highs of 4,800. However, still got a lot of bulls out there ignoring the macros of inflation and rates and just pointing to earnings, saying they'll show AI spending wave hitting the shores of the tech industry, and the bears are wrong to fret over valuations. And that's the ever bullish Dan Ives from Wedbush, saying tech earnings will come in strong for the fourth quarter. An uptick in consumer demand will help AI become increasingly mainstream beyond NVDA and Microsoft, and he's referring to it as the AI spending tidal wave. We've even got UBS taking it one step further, saying the growing adoption of AI will drive tech stocks high for the rest of the decade, saying the rise of artificial intelligence is just getting started and it's going to have a big impact on tech stocks, saying they believe we're only in the first innings of the AI story and that AI will be the stock market's prevailing theme for the rest of the decade. However, not everybody's feeling so good about things. That's Wall Street's #1 man, JP Morgan CEO Jamie Dimon, saying we shouldn't assume everything is hunky-dory, as rising stocks are like a drug, saying geopolitical risks and the Fed's policy moves have yet to unfold in the economy. And let's not forget the ballooning US government debt, which markets seem to have forgotten about the last couple of months. Could potentially see a return of the bond vigilantes if we do see some surprise upticks in inflation, which, like we saw a little bit last year, could cause buyers to boycott US debt, which could separate yields from Fed policy. And going into a federal election in November, that's not really a time when the government wants to tighten its belt on spending. If anything, they want to keep spending up, get the economy and consumer feeling good as the Democrats try and hold office. And as Ray Dalio points out, a Trump or Biden election win could hit markets either way. He also warned that markets are pricing in a Goldilocks economy, but in contrast, he expects growth to disappoint as pandemic savings dwindle and debt costs rise, inflation to remain about 1 percentage point above central banks' targets, and rates to fall more slowly than predicted. Like Jamie Dimon, he also pointed to geopolitics as not being priced in by the market. Also got the world's second largest economy and stock market still sliding down, and that is China, with their GDP and retail sales data coming in a touch lower than expected, but still high overall compared to the rest of the world. Their GDP expanding 5.2% in the fourth quarter, but that's still one of its lowest levels in decades. They're used to growing at 7, 8, 9%, and we're continuing to see media headlines that are often associated with levels of capitulation, like this here. Chinese stocks notch their worst day in over a year as economic turmoil keeps global investors bearish. And so it's not just Chinese stocks themselves that are risky and volatile. I think a lot of people forget how leveraged and vulnerable a lot of large US tech companies are to China for their manufacturing as a market they sell into, and could be at risk if China does decide to go into Taiwan later this year. And a lot of companies, especially like Apple, who still heavily rely on Chinese manufacturing. Let's not forget, Apple showed negative growth in revenue over the last year, and they don't exactly have an AI product to sell like a lot of their peers do. And so with tech stocks already richly priced and valued compared to the rest of the market's really saying they're going to keep growing exponentially, and none of these Chinese risks are priced in. However, looking at all the Magnificent 7 stocks, Apple and Tesla are the 2 weakest this year. We've got Apple down 5% to start the year, and Tesla down over 13% so far this year. And just looking at the largest Chinese ETF on US exchanges, the iShares China Large Cap under ticker FXI, fallen 2.5% today. And just taking you out to a monthly chart, we could potentially be setting up a big double bottom from the October 2022 lows. And believe it or not, the market is back to the same level from the global financial crisis lows 15 years ago in late 2008. Same deal with Alibaba, trading well below its IPO price of $92 a share a decade ago. Back then they were doing about $8 billion a year in revenue. Now they're doing $125 billion a year in revenue. Stock market and many investors just seem to have given up on Chinese equities. However, that sets up fertile grounds for a contrarian play. Also getting hit hard this year is clean energy stocks. Solar, wind, hydrogen, basically everything except uranium is getting whacked here. You can see that in the Invesco Clean Energy ETF, getting pretty technically oversold here, but my indicators are saying we could be finding some support and due for a bounce. Got the institutional buying indicator going green, getting a lot of reversal signals, and we've got a bit of a volume here on a small hammer. I'd say some big value buys are stepping in here. These are attractive levels to add for a long-term investment. Same deal with solar stocks and a small part of the clean energy market no one really talks about, and that's hydrogen stocks, deeply oversold as well. Like I said, it's really uranium holding up much better than the rest of the clean energy industry. Moving on to crypto, and it's public enemy number one, Jamie Dimon again. Still sees no value in the Bitcoin after ETF's debut. Went on to say, please stop talking about this stuff. Saying, I hope this is the last time I'm talking about this Bitcoin with CNBC. So help me God, pointing that Bitcoin does nothing, but did reiterate his view that blockchain technology has great potential. It's a technology, we use it, it's going to move money, it's going to move data, it's efficient. Something I agree with as well. Blockchain technology is obviously here to stay. It's just the valuation of these non-government digital currencies that's the question going forward, because I don't ever think global governments will allow Bitcoin to become what it was originally intended for, and that's to be a global anti-fiat currency. And I think that's what Jamie Dimon thinks as well, and why he says my personal advice is to don't get involved, but I don't want to tell anybody what to do. It's a free country. There's a look at Bitcoin, still just tracking a bit sideways here, just underneath the 50-day. And there's a look at the largest and newest Bitcoin spot ETF from BlackRock, the iShares Bitcoin Trust. IBIT coming out of the gate a bit soft here. Doesn't look like all that buying from the Bitcoin ETFs, of which they've already raised about $1 billion collectively in the top 10 Bitcoin ETFs. Hasn't really moved the underlying market that much. Seems more like we've had a bit of a buy the rumor, sell the news event. But who knows what could happen. The market could definitely pump again. We'll be keeping an eye on it, as it's going to be one of the most interesting stories in financial markets this year. Moving on to Tesla. They've also started cutting prices in Europe after we saw them do the same in China a week ago. That was in Germany. They slashed prices by 5,000 euros for two versions of its Model Y, now costing German consumers just under 56,000 euros for the performance model, and that's making investors a little nervous again. We're still trying to find support here in Tesla, technically oversold as well. Got a pretty high reading on my institutional buying percentage indicator at 69%. We've also got them reporting earnings this time next week, with them expected to deliver 73 cents per share in EPS. Just looking at the fear and greed index, had a bit of a material drop from yesterday, where we closed at 70. Here we are at 58, just holding on to the greed zone. Market's starting to get a little bit nervous here. We can see that in the options market today. Quite busy for a Wednesday. 47.3 million contracts traded, and very unusually lopsided towards puts, coming in at 54%. Appears to be a bit of hedging going on out there, and a bit of a dive in short-term breadth as well. Now only 28% of S&P 500 stocks above the 20-day average, and once again we're starting to see stocks hitting new lows outnumber new highs as measured by the traditional new high, new low indices. And just looking at all stocks and ETFs that traded at least $1 million of shares today, when he had 93 stocks and ETFs breaking out to 52-week highs. Notable ones being AMD, Visa, and T-Mobile. And then quite a pickup in the amount of liquid stocks and ETFs breaking down to 52-week lows, coming in at 213 today, more than double new highs. With notable ones being ExxonMobil and once again Alibaba and Chinese ETFs. We've got a pickup in VIX, but the volatility curve is still in a normal contango state. Market's not super worried just yet. We'll keep an eye on the volatility risk premium that did just break out to a multi-month high. Market could be getting on edge here. Do have the TLT continuing under its 50-day VWAP, and high yield bonds starting to come up to that level now as well. It's another gauge of risk sentiment in the market. With the dollar pushing higher, shipping rates holding up, which is inflationary, and then gold just looking soft once again. Got a feeling unless we get any new outbreaks in the Middle East conflict, we may get a bit of a pullback in gold here with this strong dollar, and we could come down to test these lows from mid-November around $19.50 an ounce. Keeping an eye on crude here, we have got a bit of a bullish divergence forming. Seems to be holding up pretty well even with all the supply out there. Market's just nervous with what's going on in the Red Sea. International stock indices a bit weak this midweek, led down by the China 50. We've got commodities versus stock spread potentially bottoming out, forming some bullish divergences, and there's a look at inflation expectations, finding new highs again today above the 50-day. It was gold miners and solar stocks, the weakest sectors today, and like I said, we've got consumer staples holding up pretty good. A bit of a defensive rotation. My 2024 picks, little weak today, led down by Chinese small cap stocks and a bit of a pullback in the cannabis ETF. Had a huge move down yesterday in Spirit Airlines. The federal judge blocking the merger with JetBlue. It's been absolutely whacked. Just a week ago, we're trading above $16 a share. Here we are at $6 a share. However, even though the business has some issues, probably why they wanted to merge, it's not completely left for dead. My stock fair value indicator still got it a bit above $11 a share, so this potentially could be setting up for a dead cat bounce. However, of course, it's very volatile and risky. We'll keep an eye on this one, see what happens. And still a bit of weakness in the banks with the regionals to report over the next week. And the big guys continue trading down after they reported late last week. And we just had Charles Schwab come in today. Actually beat a little bit. Market gap down heaps, but the dip was bought. Still finished the day down 1.34%. And there's a look at the biggest of them all, JP Morgan, still managing to just hold on to its 50-day. All right, guys, there we are. Still peeling back from these all-time highs on the S&P 500. It's really the semiconductors holding things up. But like I just showed you, we've got a bit of weakness underneath the hood. Breadth getting a bit soft. Volatility popping up. Yields popping up. Last thing to pop up will be crude. If that does, that could really get worries of inflation climbing back again, especially on the back of those hot retail sales. It's looking like the Fed may not cut in March, which could cause the stock market to give back part of this rally that was kind of built on that notion. We really won't know until we get those CPI numbers come mid next month. Until then, we'll keep a watch on all the key assets. That's all for today. Thanks very much for tuning in to Click Capital and supporting independent amateur financial journalism. I know you got a lot of choices out there, and so I really do appreciate you tuning in to Click Capital. Thanks very much, and we'll see you again tomorrow night. Cheers.